Well, thanks a lot. I'm very happy to be here. My name is Chris Mancini, Associate Portfolio Manager of the Gabelli Gold Fund. And I'm very happy to be here today with John McCluskey, who is the President and CEO of Alamos Gold. Alamos Gold is a very big holding in our gold fund. It's done extremely well for us over time. We've been holders of this stock for a very long time. Alamos is a $7 billion market cap company. It's going to produce around 500,000 ounces of gold this year, and that's growing to a large degree. And what we like so much about Alamos, one of the things we like so much about it is that the company has engaged in very value accretive M&A. And what I'd like to focus on with John today is how he's gone about this in an industry which really has done a lot of value destructive M&A, mergers and acquisitions. John and his team have done a fantastic job in finding excellent merger and acquisition targets and executing on those deals. So John, thanks a lot for being here, and let's get it started. The first thing that I'd like to ask is, can you tell me just a little bit of your background, where you were born, what you majored in college, and then like how you got started at Alamos?
I'd be happy to do that. Thank you very much for having me, Chris. So I was born and raised in Vancouver, Canada. My parents were immigrants. They had both been in the Second World War. My mother was in a British women's regiment called the ATS. My father was in the Royal Engineers, and so after the Second World War, they wanted to break away and new opportunities, and so they immigrated to Canada, which for both of their families just sounded like an absolutely insane idea. But they came to Canada. They settled in Vancouver. I was born about 3 years later. I was their first child born in Canada. I had two older sisters that were born in Britain, one in Scotland and one in England. Anyway, that was a big move my parents made, and I suppose when they got to Canada, they wondered what they were doing there as well, because I think at first they felt like fish out of water, but they settled and they prospered. I grew up in sort of a hardscrabble part of town called East Vancouver, and I went to Catholic schools, and then I went on to Simon Fraser University, where I did not major in anything to do with mining. I actually majored in history and English literature. And one of the things you have to face if you decide to study subjects like that is you better figure out what you're going to do with yourself when you get out of school. And honestly, I had no clue. And I think if I had have dreamed about being an engineer or a doctor or a lawyer or something like that, I would have gladly studied those things, but I had no such interests in those subjects at the time. And so I literally got out of school in the midst of one of the deepest recessions that we'd ever seen at that time. It was it's like 82 going into 83. And I had really a willingness to do just about anything. I was interested in a lot of things by that time, willing to do just about anything. I was looking for an opportunity. One thing led to another. I got introduced to Chester Miller, and he said I should come to work for him. And that's how I got going in the mining business. He was just starting up a little company called Alamos Gold. I think it had about an $8 million market cap when I started there. And this was the very, very beginnings of open pit heap leaching and little junior companies trying to get projects like that started, getting them started through bootstrapping, little capital going in, get the gold out of the first heap, reinvest it and grow it. It was a very, very good idea. And it allowed him to build that mine on next to nothing. I mean, the company basically financed its own expansion through the cash flow generated from the small heaps. It was a completely novel concept at that time. And before very long, Alamos went from a few $1 million. One day I woke up, it was a $30 stock, and it was this all happened between say 1982 and 1987. Of course, the market crashed in 87, and all those stocks sort of lost their way for a while. And gold had run when I started. Gold was trading at maybe $295 an ounce or something like that when I joined that company. And it had hit over $500 an ounce by January of 88. I'll never forget that. And I thought, well, the stock market's been really rocky, but at least gold's solid. And I had no sooner got those words out of my lips than gold started to head down. And it went through a really, really long contraction. And that lasted until probably 93. But anyway, that's how I got started in the gold mining business. And I have to say, it's been an up and down affair. The gold price has, over the majority of my career, it's been in a bear market. It certainly was from 1983 to call it, 2005. That was a very protracted bear market, and every now and then you'd get a little breath, and just enough to keep us all going. But I'm a natural bear, and so when I say today that I'm bullish,
Yeah.
That means something. That's different.
Yeah. Well, that's awesome. I mean, I agree. I'm kind of like, I've been doing this and I've been getting kicked more than I've been getting, for like close to 20 years. And, it felt like getting, gut punched more than being lifted on shoulders. So I think that we are in a good time now. I agree. So we discussed that prior to starting the recording, but yeah, we can maybe save that for another video. But so how did then Alamos get started? And how were you involved from the initiation of Alamos? How did that all go down?
So I left Glamis in 88. The story sort of has one continuous thread. I left Glamis in 88. I went out and started doing some entrepreneurial things after that. And I did quite well over the course of those years. And in 1994, I got a phone call from Chester Miller, and he says, I've been thinking we should start something up together. Let's start a company and see what we can do with it. And I wondered what he had in mind. And he's, one of the things that really intrigued us is that Mexico had changed the mining laws. And prior to this, you couldn't own assets in Mexico. You had to be a minority partner, and you had to have a majority Mexican company control whatever the interest was. So as a result, there was very little foreign investment going into Mexico. They needed to turn that around, and they changed their laws, and they basically invited foreign mining companies to come in and start to work in Mexico. Well, at the time, it was not a great market. The majors were quite skeptical, I would say. For example, even Newmont, they had already established a joint venture with Peñoles. It was called the Penmont joint venture. It still exists. And Peñoles and Newmont owned assets, but in every case, Peñoles would be the majority owner. I think it was 56 to 44, something like that. It was a split in favor of the Mexican company. So that was the backdrop to the market. There was really the majors didn't go, crashing into Mexico as soon as the laws changed. It was actually juniors. And we were one of the first of the junior companies to go in there, but we were still private. But we went in, we pulled some capital, and we acquired some claims. The first claims that we acquired were around a little colonial town in the southern part of Sonora State called Alamos.
Okay.
Hence the name Alamos Gold now, but we initially called it Alamos Minerals. But we took it public in 96.
Okay.
And that was June 96, and not long after that, the whole market crashed. You probably remember that.
Yeah.
And the whole metals complex crashed. It was exacerbated. The junior end of it was exacerbated by the Bre-X scandal, and there's actually a few smaller ones that nobody remembers because Bre-X was so outstanding. Anyway, the junior cycle had come to an abrupt halt, and things stayed at that bottom. It continued to lower right to the summer of 99. And by 2001, I was convinced gold was going to make a turn. I looked at the length of that trough, and I just said, you know, it's got to turn. And just think different things that were going on in the world at the time. It looked like things were lining up, and I went to Chester Miller and I said to him, you know, I think we should revive Alamos. It was still listed. You know, the Vancouver Stock Exchange had disappeared. Most of the brokerage firms had gone out of business, and they consolidated all the juniors onto an exchange they called the TSX Venture Exchange. So it became part of the Toronto Stock Exchange, and there was no floors anymore. During this time, all the old floors, the TSX floor, the old trading floor in Vancouver, all those things were wound up. Everything was basically, it was all electronic trading after that. Everything had turned into a NASDAQ. Right. And but it existed in Toronto. It was all governed under the Ontario Securities Commission. So BC was sort of finished as far as equity issues and all that was concerned. So so here we had this little listing. It had nothing in it except $400,000 US cash. That's all it had. And the market cap of the company was exactly the amount of cash the company had. Was 400,000 US dollars, or about 600,000 Canadian. And I was aware that that Mulatos was something that could be acquired. And I said to Chester, we should go after it. And he said, well, I agree. I think we are in a bottom. Let's see if we can get it. And for the next, call it 2 years, I wasn't employed by the company or anything. I was a director. The company had no employees. But for the next 2 years, I was sort of working on pursuing Mulatos. And in the end, I succeeded in getting it. And initially under a joint venture with another junior who had the direct option from Placer Dome. We did a joint venture with them, and then within 6 months of that joint venture being established, we took that junior over, consolidated the asset under one roof, which was the Alamos roof, and changed the name to Alamos Gold. And that was accomplished by February 2003. And believe it or not, the company had no cash, no employees. We had no permits. We had no water rights, no feasibility study. We had nothing except we'd secured the option. We exercised the option, paid off Placer Dome, $10 million. That was that. Yeah. And 2 years later, July 2005, we poured our first gold bar. So in that time frame, we'd obtained all the permits, the water rights, which Placer Dome could never get, a deal with the local community, the Ejido, which nobody ever believed could be achieved. We raised all the capital, hired everybody we would need, hired 450 people, and built the mine and had it producing gold, and poured our first bar in July. And we produced 95,000 ounces in our first year.
No, it's amazing. Just what I've noticed, you know, over time, having done this for so long, is it's amazing, really, like you say, the entrepreneurial spirit and the grit of the gold mining industry and the gold mining executives. It's like it really is a different breed. Like you guys are. I'd say maybe investors have to be a different breed, you know, to some extent, maybe a little crazy to get involved, but the guys, you know, actually building the mines and running the companies, it's amazing.
Well, it's interesting to look back at the investors that did participate, because I tried to raise money around Vancouver, that whole network that I had. I'd been there for 20 years, and almost nobody would put any money in.
Yeah.
And you'd be surprised at who financed it. It was a group of funds out of Toronto. You know, the big sort of blue chip companies you would never imagine would put into a tiny, tiny little junior like that. Like they knew it wasn't, they knew it was all about the asset, and it had nothing to do with the market cap of the company or anything else. They knew who we were. You know, I was well known by then, and so was Chester Miller, far better known. You know, he was he's now, a few years later, was in the Mining Hall of Fame. But and if you look back at the company, we went from literally sub 1 million market cap to like 150 million in market cap inside 3 years. So if you did participate in those finance, the first one we did was 15 cents a share with a full warrant. Like if you bought that stock, like 2 years later, the stock was trading at $3 a share.
Yeah.
I
No,
mean,
it's amazing. Yeah.
there was lots of money to be made if you were willing to take the risk.
That's the thing. Yeah, yeah. It is. It's really a risk taker's business. And again, hopefully we get rewarded and all of our shareholders get rewarded. But can you talk for a sec about Mulatos? I always remember Alamos, since I've been looking at when it was just Mulatos. Alamos always traded at a big premium, or frequently, or from what I recall, it always traded a big premium to single asset peers. And can you, and I, it was because it was a steady producer, low cash costs. But can you talk about what made Mulato stand out and why you think it did trade at a premium to peers? So yeah, why Alamos traded premium to peers when it was just Mulatos?
You've started to point the conversation in the right direction. It was all about our focus on costs. So when we first got it going, we got into production on a wing and a prayer. We built that mine for $72 million. And in the feasibility study that we had, it said we could build it for $72 million. It was a miracle we actually built it for the price that. But we did things like we bought the crusher out of Nevada. It was secondhand. It had been running at the Kennecott's rawhide operation. We bought the whole thing. I remember when it all showed up. Like they just wanted to get rid of a lot of the stuff they had on site. It was a liability to have them. So we got the crusher, all the conveyors. It was a staggering amount of equipment that showed up on site. We took the crusher to where was it in Arizona? I guess in Phoenix, Arizona. We had it all refurbished there, and then we had it shipped down to Mexico and got it set up. But what would have cost us probably $30 or $40 million? I think we paid something like $2 million for it. It was like a bargain basement, and we bought the ADR plant from the failed Brewery Creek mine up in the Yukon. So it was just sitting there. You know how things are in the frozen north. It doesn't rust. It doesn't deteriorate at all. It was just sitting there like it was brand spanking new. It had only been operating for a few months. And again, we bought it for about $1 million, what would have probably cost $15 million to build. We got the whole ADR plant, a truck shop. It was just, again, an incredible bargain. We shipped it all down to Mexico by truck and rail and set it up, and it's still running to this day. We were able to make some amazing deals at that time that allowed us to build that mine right on budget. As time went on, though, we recognized that we had an opportunity to increase the scale of it, and as we did so, we took advantage of the economies of scale. So we started it at about 6,000 tons a day. We took it to 10,000 tons a day, then to 15,000 tons a day, and then ultimately went to 20,000 tons a day. And as we increased the throughput, just getting more and more efficient, we also noticed that we could improve recoveries if we could crush it finer. Well, as the gold price went up, we could afford to recirculate the oversize, and it would only pass a 3/8 inch screen. And that got us the finer material onto the leach pad. So we were doing fine crushing and agglomerating. Recoveries went way up. So we were generating more gold at a lower cost. As gold prices were going up, our costs were going down, margins were expanding, and the market, that was exactly what it was looking for.
Yeah, that's amazing. Okay, that's great. No, I do remember that, and it was always trading a premium, and I think that we actually, I remember when I first started looking, I was like, okay, this is trading at a big premium. We might have had a small position in it, but we did have a big position in your the first, I guess, big acquisition that you did, which was Aurico, and they had the young Davidson mine. And can you talk about, now I remember, now, this is my recollection here, and it's interesting as an investor, it turned out that they actually had borrowed too much, it seems, to build the mine. Or what I guess and you guys had a lot of cash and this great free cash flow generator in Mulatos. Can you talk about what you saw in the opportunity at Young Davidson? Because from my recollection, again, I don't think you guys even paid a small premium for it, or no premium. It was a merger of equals at the time. I think this was a fantastic deal for you. Can you talk about what you saw there, what the opportunity, and again, what maybe just prior to that, how you were able to exercise so much patience in terms of not doing a deal for so long with a stock that's trading at a big premium with this really good paper, and then buying the right one at the right time?
Well, I was able to watch how Glamis grew, and it always bought at the bottom of the cycle. And I remember Chester Miller saying the only price you can practically control, because miners are price takers, whether we're buying fuel or lime, cement, cyanide, whatever it is, you're a price taker. The one thing you control is what you pay for an asset. And so you want to be very careful about when you step into the market and make that buy. So as a matter of fact, we first looked at Young Davidson in 2010. If you remember back, it was a Northgate asset. They had just let Ken Stowe go. He was the CEO of the company. And it was a signal to the market that they were in play. And we were one of the first companies to approach them, and we offered them like a 35% premium.
Wow. Okay.
Which to their market cap at the time, that was a very reasonable offer for what we thought was a high quality asset. And what we didn't know is that they were cooking up a deal with another company altogether. And they announced it. It was an absolutely terrible deal that they announced. And not long after that, Aurico threw its hat in the ring, but not for a 35% premium, for a 60% premium.
Right.
So,
Okay.
So they ended up paying something like $1.6 billion to acquire that asset in, I guess, 2010, 11, something like that. And that was just too rich for my blood. And so now it was an Aurico asset. Now we quite liked it. I just liked the scale of it, lots of ounces to find. It looked like if you knew what you were doing, you'd be able to make money there. But it was all the trick was bulk underground mining. You had to mine that asset at a sufficient scale to get your costs down so you could turn a profit.
Yeah.
And we recognized that that it had to be done at probably in the range of about 8,000 tons a day. So here's what Aurico ran into. They paid $1.6 billion to acquire it. And not long after they acquired it, the whole gold price collapsed and the stocks collapsed along with it. So what they had thought about doing is essentially starting with an open pit, using that cash flow to sink the shaft and build the infrastructure at the mid-level, and then use production from underground to again further finance the sinking of the shaft. It was an interesting plan, but it was predicated on being able to generate sufficient cash flow from relatively low volumes. And the gold price just didn't go with them. And and so they weren't generating the cash flows that they needed. Then they took on a huge debt. They took on $320 million in debt with high yield notes. So the interest rate was pretty punishing. And again, they were operating from the mid-level infrastructure at this time. They were only doing about 3,800 tons a day, which wasn't even breaking even. And so how were you going to finance your expansion? They were down to just under 100 million in cash. And I think once the CEO saw the cash balance go below 100 million, it became, a spiral, and people started to get concerned. And so we talked on and off about putting the companies together in previous years, but it really took Scott Perry to call me that January, it was January 15, and say, you know what, I think there'd be a lot of merit in putting these companies together. He says, I've always thought so. But it's all about timing, and I think the timing's right. And he was quite right about that. And by April, we had announced a merger, and both companies, as it would turn out, had a market cap of about 750 million American. And we put them both together, closed it that July. This is July of 15. The gold market was $1,100 an ounce. So virtually right at the bottom. And by the end of the year, with the gold price continuing to weaken, by the end of the year, the combined market capitalization of the merged company was exactly what the Alamos market cap was prior to the merger. The whole thing had come. In other words, the market had given that whole deal a big thumbs down. And yet it was an amazing asset. And we knew it, but it was going to take a fair amount of investment, which ultimately was paid for. We managed to get the cash flow from the mine to pay for the expansion. We sunk a shaft down to 1,500 meters. We put the ramp down there. And then we built a whole new crusher circuit underground. And instead of trucking ore over to the skips, we put in a big conveyor system, runs about 1 kilometer underground. And we completely automated the whole thing. And so costs just came way down. Volumes went up to 8,000 tons a day from 3,800 tons a day. And that mine has been generating 100 million in free cash flow every year since 2020 when we finished that construction. So I think it was, in hindsight, it was all about knowing that that big ore body, if it was set up properly, could be incredibly profitable. And then it was all about executing. And Alamos had the team that could execute it. And interestingly, it was built up by a mix of existing engineers from the Northgate Aurico side and from the Alamos side. We blended that team and it worked so well together. And, we never looked back. That was a great acquisition for us.
Amazing. I visited the mine and it runs really well, and the stopes are huge and wide, and it's a good grade, and it's going to be going on for years and years. So yeah, it's fantastic. So that was a great acquisition. What the next one then was Richmont, and we actually owned Richmont too for the Island mine, which we thought had great exploration potential, and this has turned out to be a fantastic acquisition for you. But I guess, can you talk about what you saw in Richmont? And again, like, your stock got hammered afterwards and the market was wrong, I'd have to say. But how do you deal with that? How did you deal with that, with your stock getting hit? Like, I guess the question is, if you will, what did you see with Richmont? How did you deal with the market, kind of not approving of the deal from the get-go? And then, what did you do after you bought it? And can you talk about that?
Well, you're sort of hitting on a theme.
Yeah.
When I acquired Mulatos, nobody in Vancouver would finance it, because their attitude was, if that thing was any good, you would never have been able to get it. And then the first major deal we do after that is the acquisition of Aurico. And again, John Ing was a very famous analyst here in Toronto. He was interviewed on BNN the morning that deal was announced, and he said, two little garbage companies, you just put them together, just a bigger pile of garbage. And that very morning, his big table pounding recommendation was Barrick Gold.
Yeah, right. Which
so that's where that's where its head is, right? And when I was interviewed later that day, the interviewer, trying to mix the red ants with the black ants, he said, "Hey, John Ing says this is just a pile of garbage, and you guys are." And I said, "Well, what's new? That's the way the market works." I said, here's an interesting fact. I said, we're on the 20th floor, and John Ing is on the 18th floor of my building, 2 floors below. He's never once come up and knocked on our door, said hello, what are you guys doing? You know, he knows nothing about our company, absolutely nothing. And yet he's willing to come on television and tell everybody who's willing to listen that this is just a bunch of garbage. Well, I said, I think he's wrong, and we're going to prove it. And of course we did. So if you look at Barrick stock from 2015 until now, I think it's pretty flat.
Yeah.
And if you looked at our stock, it's gone from under, what would it be? It's gone from 750 million US market cap, and today it's 7 billion. So a factor of 10. So if I were John Ing, I'd be giving me a call and saying, geez, sorry about that, pal, but I've never heard from him, and I doubt I ever will. But it just, the market is, I'm a big believer in markets. First of all, I'll say this, I'm a big believer in markets, and it's what's made us so wealthy. But markets eventually get it right. They don't initially get it right. In fact, in our business, they rarely get it right. And you've pointed out that when we bought Richmont, the day we announced the deal, the stock was down 16%, one of the biggest settles to that time. Yeah. And within a year, by the end of that year, our stock was down 38%. Yeah. We were one of the worst performing stocks. What did we see at Island Gold? Probably what you saw, that they didn't have a lot of drilling to depth at that point, but the drilling that they had done demonstrated that the grade was going up as you went deeper. Yeah. And that is a very rare thing to find. But there's a number of examples of this in the market. And the first one, of course, was Rob McEwen and Red Lake. So what suddenly put Goldcorp on the map was their insight into the fact that as you went deeper into the mine, the grades were going up, and the mine was going to get more profitable. And that's what happened. So gold prices went up from roughly 96 or 97 when he was trying to get that going. The gold price turned around and started going up. And he benefited from an amazing discovery. And that's exactly what we saw at Island. And we've made that a reality. When we acquired it, I think the grade was around 9 grams, and there was about 750,000 ounces of reserves and maybe another 1 million ounces or so of inferred. And today we have close to 2 million ounces of reserves, and we have another 4 million ounces of resources. So we're up to over 6 million ounces, and that's net of 1 million ounces of depletion. Right. So that mine and the costs have been amazing. With the big expansion of reserves and resources, we had enough scope to justify the sinking of a shaft. And that's going to be the next big phase in development for Island Gold, because we're going to be able to double production to 2,400 tons a day, taking production from when we bought it, it was under 100,000 ounces a year. We'll be mining it at 300,000 ounces a year and probably growing it from there.
Yeah. So, right. So this is going to be now one of the best mines in Canada, if not one of the best mines in the world, really, in terms of the margin, production, jurisdiction. And then right next to Island is the Magino mine, which again, it would seem like it would make sense to put these two together. And but the owner of Magino, Argonaut, wanted to build it on their own and borrowed it again and kind of ran into trouble. And eventually, just recently, you just closed on an acquisition of the Magino mine, which again, it's going to turn out to be. This is one where the stock actually, I forget, it wasn't down. It might have gone up a little bit in the couple of days post the deal. So I guess the question is, from my view, now that I'm mentioning it, maybe if it went up, now the market's wrong that way too. But I don't think so. I think the market was right in taking the stock up, and I think it's going to go up a lot more from here even. Can you talk about, again, like the patience that you were able to exercise there, how the deal came together, and then what the combined assets will mean for Alamos going forward?
So Argonaut had been in this district longer than we had. They had acquired Magino mine from a company called Prodigy, and I think they paid around 600 million to acquire it at the time. And so they've been working away there for a number of years, drilling and expanding and doing feasibility and one thing or another. And we came along at the end of 2017 and bought Island Gold. In 2018, we signed a confidentiality agreement and went over and visited the mine for the first, well, it wasn't a mine, it was a gold deposit. We visited it for the first time and started looking at the data and so forth. And right off the bat, you know, we had a very different view on the deposit than they had. So they thought the grade was just over 1 gram. I think they had 1.2, 1.4 grams, something like that. And we thought the grade was probably about 1 gram. Now, that doesn't sound like much of a difference, but on the number of ounces we're talking about here and on the volume that it takes to make a mine like that profitable, like it would probably be, it should have been built probably to about 20,000 tons a day. You know, the difference of 0.2, 0.4 grams, that can be your profit margin, especially when the gold price, you know, the gold price at that time was probably $1,600 an ounce, maybe. And so when we first looked at it, you know, our view and their view was pretty far apart. And then as time went on, they were very heavily promoting that stock. We were producing a lot of data as we were drilling to depth and starting to expand the Island Gold ore body. You know, we were coming up with high-grade intercepts over big widths and really expanding Island Gold. And so they started drilling to depth, and you can intermittently hit high grade underneath the Magino pit. It's there, but it's just discontinuous. They've never been able to establish continuity of high grade at depth on the Magino side, because effectively the ore body or the host for mineralization changes. On one side, where you have Island Gold, it's shear hosted, so everything's trapped within a structure. But by the time you cross into what became Argonaut's property, it had changed and it had turned into a stockwork called the Webb Lake stock. And so everything was disseminated and distributed in a big, wider way at a lower grade, not the concentrated grade that we had in the shear. So we knew they had high grade, but just not the continuity. But by sort of promoting it as if it could be another Island Gold, their stock went to $4 a share. And at $4 a share, that was pretty rich, given what we thought about the thing. Well, time went on, and they eventually raised the capital, and they built the mine. They sunk about $1 billion into construction of the mine, and they built a 10,000 ton per day mill, not quite the scale we thought they should go for, but I think it was a question of capital. They built what they could with the resources they had. And remember, they're trying to do this all in a pretty tough market.
Yeah.
That's generally, you know, where, you know, when you undertake the construction of a project like that, it takes years to get it done. You can't always predict the way things are going to go. And so for them, two bad things happened. The gold price kind of went down and their capital budget went up. So they thought they could build it for about 480 million. And in the end, it cost them $1 billion. And the gold price, instead of going up, the gold price went down. So they got trapped in all that. And eventually the story about the high grade at depth kind of caught up with them, because they were never able to produce enough evidence to really convince the market that that was there. And now I own it, you know, and I'll tell you, it's not there. You know, the opportunity at Island Gold is an open pit deposit. It has roughly 4 million ounces of gold that we've got to, you know, engineer. And one of the things that we're doing right now is looking at expanding the pit, not trying to find high grade at depth, but we think that there's a big opportunity to expand the pit to the east onto what was formerly Alamos ground. Like there's evidence that pit could be expanded, and ultimately I think what you have to do is take that volume up. You have to take it from 10,000 tons a day, probably to about 20,000 tons a day. And effectively, we plan on unitizing the whole camp. So essentially, all the high grade coming out of Island Gold will go into the mill, that brand new mill that they built on the Magino side.
Right.
And we will continue to feed the material coming out of the open pit into that mill as well. So for a while, it'll sort of operate at, by year end, we need to get it at about 11,200 tons a day to accommodate production from both mines. By 26, it's going to have to do 12,400 tons a day to accommodate all the ore coming out of both operations. But long term, so I'm sort of aiming for something like 28. You want to be able to increase the capacity of that mill to something in the range of 25,000 tons a day. And on that basis, you'll probably be optimizing that open pit operation because you'll have enough scale so that you'll be able to do it at lower cost. And from the underground side, I envision we'll have Island Gold operating at about 3,000 tons a day. On a combined basis, those two mines then would be generating about 650,000 ounces of production a year at about $1,000 all in sustaining costs.
Yeah.
That's the reason to pull it all together, because together they'll be worth way more than either one of them ever would be on their own.
Yeah, that's again, fantastic deal. And off the bat, I mean, like you're not going to spend the capital on the island mill, which you were going to have to on the mill expansion, and so it just saved so much money. It was a great, fantastic deal. So I think we're going to benefit.
I think what the market liked immediately was we were able to point out conservatively over $500 million in synergies.
Yeah,
like that's conservative.
Yeah.
And you know how companies always talk about synergies when they merge, right? And then they never happen.
Yeah.
Well, these were just so blatantly obvious
exactly.
that the market didn't even take convincing. I mean, before we got out and visited one investor, as you pointed out, the stock price had both stock prices already started to go up. And partly that had to do, I will acknowledge, there's always a bit of luck involved. You know, the very day we announced that deal, that was when gold prices broke out.
Right.
You remember?
Right. Yeah. I do. It was in March or something. Yeah,
They broke about 2,400.
Yeah, I was going to pick my son up from college, and I saw the deal, and I saw the gold price go up. Yeah. Okay, great. And so, right, and then the last deal, I guess, was a small one, but it's in terms of what you paid for it and the potential return, it could be, really big. Also, was the Carlisle deal where it was a very small acquisition, but it's turned into what will likely be, your next mine, and it seems like a very good project in Canada. Can you talk a little bit about how much you paid for that, and what you see Lynn Lake potentially being?
Well, we paid just over $20 million to acquire a little junior called Carlisle Goldfields. And we closed that deal in January of 2016. And if you look at a gold chart, that was the bottom of the chart. Gold was actually under $1,100 an ounce for a few days. And that's when we closed that deal. And so getting assets at the bottom of the market is always the way to go. Of course, the market hates that.
Yeah.
Every investor says, "Oh, I'm a contrary investor," but they're really not, because when we were trying to make, if you notice, between 2015 and the beginning of 2018, we acquired Young Davidson, Island Gold, and then Carlisle Goldfields. We acquired all three of those. And every time we made an acquisition, our stock was hit. Yeah. And Carlisle was a relatively small deal. Like I said, we paid just over $20 million for it. And it was sitting with 1.6 million ounces of gold, if you can believe that, already defined. And there was more, those were measured indicated ounces. There was actually more gold in the inferred category at two deposits we're just drilling now, the Linkwood and Burnt Timber deposits. That'll probably, I'm guessing at least another 1 million ounces above what we know already. But from when we bought it, we were able to increase reserves from 1.6 million ounces. They're up around, I think around 2.2 million ounces now. And in reserves and resources, we're at about roughly 2.5. So if you think of how little we paid for that, and then with a relatively small investment in exploration, we've been able to expand that. So we're already heading towards 3 million ounces of gold. And of course, we were able to obtain provincial and federal permits to get the things that we've published a feasibility study. You know, we've shown it can be a very profitable mine. We're still probably 6-8 months away from a production decision, and we're doing those other things, like we're making impact benefit agreements with the First Nations communities and so forth. And you know, these are things that take time, and we've been able to make deals like this for many years now, since we've been operating in Canada. We're working with 4 First Nations at Island Gold, and at least 2, maybe 3 First Nations up at the Young Davidson deposit. So we're working with seven of these First Nations communities. Now we're taking on 2 more in Manitoba associated with the Lynn Lake project. And you know, it takes patience, and it takes an open mind and you know, an open heart to be able to come up with benefits that are going to be long lasting, and hopefully the kind of economic development that brings up the living standard of everyone within the community. You know, that's the real objective here. But by the time we get that mine into production, it will be able to produce roughly 200,000 ounces of gold a year at roughly $800 all-in sustaining costs. So it's going to be a really profitable mine for us. It's essentially open pit. So we'll have 2 pits feeding a central mill. And the mill, this is the beauty of northern Manitoba. The mill will be run off the cheapest power in the world. Northern Manitoba sources its power from a big hydroelectric complex, and frankly, it's famous for all the power it sends down to Minnesota. One of the reasons why Minnesota has such low cost power is because of the Churchill Falls complex.
Okay, that's great. Well, it's fantastic. Yeah. Okay, so this is like, so now we're talking about, as we look at it, this is Alamos going from a little junior, you know, like scraping together to get the money to build this one heap leach in Mexico, and going from a few thousand out, you know, whatever, tens of thousands of ounces up to, you know, steadily progressing. And we have a line of sight now to over 1 million ounces of gold at probably lowest quartile, close to lowest quartile, all-in sustaining costs. What do you see then in terms of like, in terms of is that what Alamos is going to be? I mean, in terms of just wrapping this up, and you know, what do you see for Alamos like in the 5 years? Is it that goal of being, or not goal, but do you see it being 1 million ounces, 1.1 and change million ounces at low costs? And what do you see yourself doing in a few years as this hopefully all comes to fruition?
Well, here's the remarkable thing. It took just over 20 years to go from a standing start, you know, with a little shell company with under $1 million of value, to 500,000 ounces of production and a $7 billion market value. Yeah. And what I find remarkable about the moment we're in now is that what took 20 years to achieve, we're going to be able to double that within the next 5.
Right.
And that is incredibly exciting. You know, we've got the people, we've got the capital, we've got an amazingly supportive board that really buys into this vision, and you know, we've got the assets. And every time you want to talk about this thing, this kind of bold expansion, you will say, well, what are the limiting factors? That's always the big question. And primarily, the big limiting factor you're going to run into are things like permitting, capital, people. You know, well, on the permitting front, one of the big drivers of this growth is going to be the doubling of production at Island Gold. You know, to take Island Gold, like right now, we're getting 100,000 ounces out of Magino and about 150,000 out of Island. So that's 250,000 ounces. Well, we've got an expansion to 300,000 ounces at Island Gold underway right now.
Yes.
So we'll already be at 400,000 ounces by 2026. Like that's coming. That's in the works. The next phase, it's already permitted because the mill at Magino is permitted to go to 35,000 tons a day. So for me to say I want to take it to 20, that's not controversial. That's all covered under the permit, right? And the other big limiting factor typically is you need to permit tailings.
Okay. Right.
Well, Argonaut permitted a 150 million ton tailings facility. That's more than twice the capacity that both mines
Wow. Okay.
going to ever need based on what we know now.
Okay, great.
So we have all the capacity in the world. We have the permits in place already. So really, it's just the time it's going to take us to get to the job, design how we're going to build it, get the job done, and start producing from it. We don't have any big roadblocks in our way. And that's what I think makes it so remarkable. And of course, another big component of it is to get Lynn Lake built. And if you look at the feasibility study on Lynn Lake, this is not a complex project at all. It's a very straightforward, you know, open pit operation, decent grade for open pit, feeding a mill where it gets very high recovery, very simple metallurgy. In other words, quite a straightforward construction. But all the better for the fact that we're able to draw on such amazing Canadian talent. And that's not just people working within our company, but all the contractors that we've been working with over the years that have demonstrated such ability and commitment to getting things done, getting it done right cost. Getting it done on time. These things really matter. I would far prefer to be building mines in places like Canada and the United States than I would say Africa or South America, some of these other jurisdictions. It's a big challenge building a mine, and I feel very grateful to be working in Canada right now.
It's fantastic. Okay, great. I was going to say, I was thinking as you were talking, I was thinking, okay, I was thinking the P's, the P's. So now you just said the fourth P. So the story of Alamos, persistence, perseverance, patience, and place. The place, Canada, is the place to do it. But no, it's fantastic. I mean, it is amazing to hear these stories again, because we speak frequently, and we always talk about, we're in the weeds about, what's happening at which mine and which operation, but to hear the big picture story. And again, every time I hear about just the perseverance and persistence and grit of you guys, it really amazes me. So it's really, really a great story, and a lot more to come. So thanks so much, John. I really appreciate your time. And
I've loved being at the helm of this company. I founded it. I've been running it for just over 20 years now. I figure I've got 5 fantastic years in front of me, and I've got a great team and tremendous talent to draw on. You were talking to me earlier about succession and so forth. I'm in no hurry to sort of hang up my spurs, that's for sure. I think these are really exciting years we have ahead. We're in best gold market I've seen probably in my lifetime. And I'm just excited to be a part of it. And we are so well positioned, as you've been pointing out. We've got the balance sheet, we've got the people, we've got the assets. We're going to be a real juggernaut in this market. And we've always traded at a bit of a premium. And I think partly it's because people have felt comfortable with our ability to grow the company. And you've pointed out how consistent we've been in acquiring things at the right price and building mines that turn out to be low-cost producers. None of that's a mistake. We looked at all the other ones too. We just didn't want to own those things.
Yeah.
So we don't care how long it takes. We know what it is we're looking for, and when we find it, we acquire it. And I think having that clarity of vision really sets us apart.
Yeah, no, it's great. Okay, great. No, it's again, we've done fantastic for us and our shareholders. So we really appreciate it, and hopefully more good times to come. So
Well, thank you for this, Chris.
and talk to you soon.
Yeah, take care.
Chris Mancini is an assistant portfolio manager of the Gabelli Gold Fund. The above webcast is an excerpt from Gabelli TV that appeared on August 7, 2024. GAMCO is providing these links as a matter of general information. Investors should carefully consider the investment objectives, risks, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about these and other matters, should be read carefully before investing. To obtain a prospectus, please call 800 Gabelli or visit www.gabelli.com. Investments related to gold and other precious metals and minerals are considered speculative and are affected by a variety of worldwide economic, financial, and political factors. Investing in foreign securities involves risks not ordinarily associated with investment in domestic issues. Funds concentrating in specific sectors may experience greater fluctuations in value than funds that are more diversified. Not FDIC insured. Not bank guaranteed. May lose value. The Gabelli mutual funds are distributed by G. Distributors, LLC. A registered broker-dealer and member of FINRA. As of June 30, 2024, the Gabelli Gold Fund held a 4% position in Alamos Gold. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800 Gabelli. 800-422-3554 914-921-5100 fax 914-921-5118 info@gabelli.com